So a client of mine had a pre-approval letter from one of the largest banks in the UAE, 1.4 million dirhams. He found the property, made the offer, seller accepted. Then the bank came back and told him they would only lend him 1.1 million dirhams. No explanation, just a lower number. So he needed 300,000 in extra cash in 10 days or the deal fell through. He found it. Most people don't. What happened to him happens to expat buyers in Dubai consistently. And every single time, the bank knew it was coming. The buyer didn't. So in this video, I'm going to walk you through what your bank will not tell you before you apply for a Dubai mortgage. The rules that never appear in the brochure, the number that kills deals after they've agreed, and the traps that are entirely avoidable if you know where to look. So the first thing to understand is what a pre-approval actually is and what it isn't. A mortgage pre-approval in Dubai is the bank saying, based on your income and your debt profile, we are prepared to lend you up to the amount X. It is not a guaranteed loan. It is not a rate lock. It is a conditional commitment that expires in 30 to 90 days depending on the bank. The condition is the property. So once you find a property and agree a price, the bank sends a valuation firm to assess what that property is actually worth in the current market. The bank then lends against whichever number is lower, the agreed price or the valuation. This is where buyers get caught. So let's say if you agree to 1.5 million dirhams and a bank values the property at 1.35 million, the bank calculates your LTV against 1.35 million dirhams. And 80% of LTV loan to value is around 1.08 million dirhams. So you were expecting 1.2 million. The difference, 120,000, has to come from you in cash before the deal can proceed further. So the gap is yours to cover. The bank will not adjust upwards. Your seller will not adjust downwards without a negotiation. And your timeline is usually 10 to 15 working days. So building a buffer into your cash planning before you make any offer. The valuation gap is not rare. It is a regular feature of this market. Now the LTV rules. Because this is where almost every expat buyer starts with a wrong assumption. The UAE Central Bank sets the maximum loan to value ratios for all lenders in the country. These are ceilings. Banks can apply lower limits based on their own risk assessment, but they cannot go above these numbers. So for your first residential property valued under 5 million dirhams, the maximum LTV is 80%. That means a 20% down payment is a minimum requirement. For properties above 5 million dirham, the cap drops to 70%. For a second or investment property, any property beyond your first, the cap is 60% regardless of the value. So that is a 40% down payment on an investment buy or the second property. And here is the one that catches the most people. For off-plan property, the maximum LTV is 50%. Central bank regulation, every lender in the UAE. So no exceptions. If you're planning to buy an off-plan property unit with a mortgage, you are not putting down 20%. You're putting down 50% minimum. And that is before the DLD fee, agent commission, admin cost. Many buyers discover this after they've already paid a reservation deposit. So know the number before you sign anything. Some banks will not finance off-plan property at all, or will only lend against off-plan from a short list of approved developers. So before you fall in love with a project, confirm with your bank whether they will lend against it. Now the calculation that kills more mortgage applications than any other. It is called the debt burden ratio, or DBR. It is the number that your bank runs that has nothing to do with your property. And the UAE Central Bank mandates that your total monthly debt obligations cannot exceed 50% of your gross monthly income. So total debt, all of it. This includes your new mortgage payment. It also includes your existing car loan, your personal loan, your credit card loan, the minimum payments on your credit cards, any other active financing you carry. So if your salary is 25,000 a month and your maximum allowance debt is 12,500, If your car loan is costing $2,500 and a credit card minimum of $1,500, you have $8,500 left for a mortgage payment. At current rates, fixed around 4% for the initial period, variable around 5.5 to 6.5, and 8,500 monthly payment supports a loan of roughly 1.3 to 1.4 million dirhams over 25 years. Before you speak to a bank, add up every single monthly debt payment you carry. The number will define your borrowing ceiling more than your salary will. If your DBR is already above 30% before your mortgage, your options are narrower than you think. Now let's come to fixed versus variable. The question every buyer asks me, and where most people make a decision they regret in year 3. Current fixed rates in the UAE sit around 3.99 to 4.2% for the initial fixed period. After that period ends, usually 2 to 5 years depending on the product, the rate resets on a variable rate based on EBOR, the Emirates Interbank Offered Rate, plus a bank spread. The 3-month EBOR as early 2026 was 3.57% and a typical bank spread of 1.5% to 2.5%. And you're looking at 5 to 6% once the fixed period ends. Fixed feels safer right now because the operating rate is lower. But here is what matters when choosing between fixed and variable. Not which rate is lower today, it is how long you plan to hold the property. Let's talk about early settlement on a fixed rate mortgage in the UAE. The central bank caps the penalty at 1% of the outstanding balance or 10,000 dirhams, which is lower. On a 1.2 million dirham loan, that penalty is 10,000. If you sell in year 2 or 3 and need to discharge the mortgage, you are paying that penalty. On a variable rate mortgage, the early settlement fee is capped at 3 months of interest on the outstanding balance. Neither is expensive in absolute terms, but fixed works better if you plan to hold long term. Variable works better if your exit window is shorter. Know your hold horizon before you choose your rate structure. So here's the calculation that surprises buyers in their 40s and 50s most consistently. The maximum mortgage term in the UAE is 25 years, but the loan must be fully repaid by the time you turn 65 if you are salaried, or by 70 if you're self-employed. If you're 45 and salaried, your maximum term is 20 years, not 25. If you're 50, your maximum term is 15 years. A shorter term means higher monthly payments, and higher monthly payments eat into DBR faster. A buyer who qualifies comfortably at 25 years may not qualify at 15. So run your age-adjusted calculations before you assume a 25-year product is available for you. So before I tell you the right order of operations, I want to be direct about something. The mortgage market in Dubai is well regulated, competitive, and genuinely accessible for expats who understand how it works. Banks here move quickly when your documentation is clean. The buyers who get caught are not the unlucky ones, they're the ones who found the property first and then tried to figure out the financing afterwards. So the right order is this. First, calculate your DBR, add up every monthly debt payment you carry and subtract it from 50% of your gross monthly income. This is your mortgage ceiling. Second, account for your age-adjusted maximum term. If you are over 40, this will change your monthly payment calculation significantly. Third, get a pre-approval before you make any offer. The pre-approval tells you your real number before you commit emotionally to a property. Fourth, factor in the valuation buffer. Do not structure your offer assuming the bank will lend you 80% of exactly what you agreed to pay. It may value it lower. Build cash headroom. Fifth, if you're looking at an off plan, recalculate entirely on 50% LTV. The payment plan flexibility of off plan and mortgage are two separate financing strategies. They do not combine the way many buyers assume they do. The process is straightforward once you know the rules, and the rules are just never in the brochure. So if you want me to run the actual numbers for your situation, your salary, your existing debts, the property price you are targeting. DM me mortgage and I will tell you your real borrowing capacity before you speak to a single bank. Link is in the description. Book in a free call, bring your salary, your debts, and the price range you're looking at, and we will speak further.